Today's talk is focused on buy-to-let for business owners. We're doing a property elevator live panel at 1:30, which is a TV show that we do on Sky, and we're doing the second. Well, this is the second time we're doing it live at the show, which we did in March as well. And then later on today, I'm talking about will there be a property crash, and should you be worried about that, and how to sort of potentially avoid that sort of thing. So, I suppose I'll just start off by introducing myself a little bit. I am the founder and chairman of a company called Nova Financial Group. We're the main sponsor of the event today, and we advise on pretty well all aspects of property investment. From, I suppose, helping people better understand their current situation and their goals, putting in place a strategy for achieving those goals, implementing that strategy through sourcing the right properties to invest in, financing them, managing them, and then helping people on an ongoing basis review and reinvest as time goes on, with the aim of achieving financial goals, which for most people is a comfortable retirement at some point in the future. So that's what we do in a nutshell. I personally am an experienced investor. My background is financial planning. I ran a very similar company in Australia that we publicly listed in 2014. I came to the UK and started Nova that same year, so about 8 or so years ago now. And I've pretty well invested in everything there is to invest in. So I've got a good experience across all the different asset classes. And I'll talk to you a little bit today about why we feel that leveraged property is the most suitable asset class for the broadest range of people. The key word there being leverage, the ability for debt. That's really what makes property attractive. I've also written a best-selling book on the topic, which is The Property Pension Plan. That's a bestseller on Amazon in the UK and Australia. And it's usually 15 quid, but you can get it on our stand today for £3. Which is actually less than it costs us to print it now. £2. £2? I think we're selling it for £2. It actually costs us £3 to print it now. They've doubled the cost of printing. That's inflation for you, right? Inflation is 10%, but apparently it's 100% on books. If you find this talk today interesting, or if you want to learn more about our approach to property investment, then I'd strongly recommend that you pick up a copy of that. If you're not into reading hard copy books, it's also on Audible, so you can listen to it. But you better like the sound of my voice, because I spent 2 days on Tottenham Court Road recording it. Yes, that's in a nutshell. That's us and me. I've invested. When we talk about property, I've invested in buy-to-let. I've done renovations. I've done developments. Of all scales. We're currently doing a 550 unit development in Bradford. And we're also building 2 houses in Wrexham. So very much broad scale so far as my experience there. I'm also not just in property. So I've got a few property businesses in the UK, but I've got various e-commerce businesses. I've got health and fitness stores in Australia. So I've got businesses across different industries. And I suppose that's quite relevant to the talk today, because what I've done over the years is take the profits from those businesses and invest it into property. And even from the more proactive sort of property stuff that I've done, the property development, for example, generally what I've done is I've taken the profits from that and put it into buy-to-let as well. So, stable assets that I can kind of just forget about, and that I know will grow in value and generate an income and, over time accumulate. A bit of a disclaimer to start with. So we are a regulated company, and therefore it's important for me to say that anything I talk about in today's talk is general in nature. You shouldn't necessarily act upon it. You should seek personal advice before making changes to your financial situation. And that just so happens to be something that we can help you with on a one-to-one basis. So each of you should have a feedback form there. Please do fill in that form. Now, part of it is literally, quite literally that feedback on the talk today. But the other part of it is about having a conversation with us about whether we might be able to assist you in some way. That's a free phone conversation, and then also, if suitable, a free one-to-one consultation, whether that be in our office across the road at Bank, or via Zoom or whatever other teleconference platform we choose to use. So I try to keep things pretty simple. and to keep terminology to a minimum. But if anything doesn't make sense, our stand is down next to the main auditorium. Being the main sponsor, we were at the front last year. What we found, though, being at the front, is that everyone says, "I've just got here, leave me alone." I want to just walk around a little bit before I talk to anyone, then they don't come back. So we're over near the auditorium, and that way they can't use that excuse. They have to talk to us. But if there's any questions that you have, please just ask. We should have some time after this talk. I'm here all day, and we've got plenty of staff down on the stand next to the auditorium, which you can't really miss because it's massive. Right, we're also running a competition for those feedback forms. So not only do you get to tell me how great I am on those forms and get a free consultation with our company, but you also go into the draw to win an iPad. So we'll collect those forms up over the talks today. We'll draw a name randomly and we'll give away an iPad to the winner. So please fill them in and hopefully you win it. So I'll start off by introducing Nova a little bit. I'll talk about why the dramatic title, how to not go broke through investing in property. Why leverage property? What are your investment options? Why buy-to-let for business owners? Types of property, the snowball effect, how many properties you might need, and then the free consultation at the end. So hopefully we can get through all of that. So just a little bit about Nova to start with. So Nova Financial Group is the overarching brand under which a number of different companies sit that all work very closely together to assist our clients in achieving their lifestyle and financial goals. So I suppose the way that we do that is, as I mentioned before, is we first off help people better understand where they are now, where they want to be. So, point A, point B, what's the gap and what's the time frame you want to close that gap in? And then what's the most suitable strategy for you to help you do that? It does surprise me how many people have never done that exercise. They want to invest or they even are investing, but they've never actually worked out their current financial position or what their future financial position needs to be to help them achieve their goals. Now, if you never do that, then how do you expect to achieve them? It's like jumping in your car and driving aimlessly. You're pretty unlikely to end up somewhere desirable. And if you do, it's only by chance. So when we're talking about something as important as our financial future, it's important to be strategic about it. And that's something that we help our clients to do. Very much an end-to-end service. So, the traditional way of investing in property is you go and speak with your local estate agent, you buy a property in your local area, whether that be a good place to invest or not, but your local estate agent will tell you it is because that's what he's selling. You go and speak with a mortgage broker, you speak with a property manager, you speak with a solicitor, a load of different services. All of these people probably never talk to each other. They all approach things from a different direction and they give you different types of guidance and advice. Whereas with us, everything is in-house. So it's all very much aligned and working together to help you sort of work toward your goals. Qualifications and experience. Well, I've been in the industry for just under 15 years. I'm an experienced investor myself. Another thing our clients like is that we put our money where our mouth is. We actually invest alongside our clients. So the types of properties that we recommend, we do buy them ourselves, and we can show proof of that, which I think is more than most in the property industry can say. It's probably no surprise that there's a few cowboys out there. And I think you do want to see proof of past performance, of case studies of actual clients, not just sort of, paid people in the audience that come up and say how awesome you are, but that we're actually doing it alongside them. I'm a qualified financial advisor and mortgage advisor. And we've also got very strong relationships throughout the UK property market, which opens doors for us and therefore for our clients. So why the dramatic title? So I mentioned the title of the talk today is how to not go broke through investing in property. Now, as a business owner myself, and certainly when I first started out in business and I only had one business, I lost a lot of sleep over that business not working. And especially when you're young and you've just managed to raise the money to start that business, if that business goes broke, well, what do? You have to go back and get a job. And I didn't want to do that. So by building other businesses alongside that one business, it made me feel a lot more comfortable. It made me sleep at night, and it means that if one of my businesses goes broke, the others are going to be okay. And property is a great way of doing that, especially if your main business is making money. If your main business is profitable, what we have found is that most successful business people have retained profits sitting in their company. They don't want to take it out of the company and pay personal tax rates on it of 40 or 45%. It might be 50 grand, it might be 500 grand, it might be 5 million, depending on where you're at. But that money can be much better utilized through leveraging it, turning, for example, 50 grand into 200 grand through a 75% buy-to-let mortgage. And therefore, by getting relatively average returns on that 200 grand property, you can get really strong double-digit returns on the cash you've put in. So we'll talk about a little bit about that in a moment, but essentially it's about starting a special purpose vehicle or SPV property company alongside your main business, which helps you mitigate the risk of your main business because, of course, for example, I've said, actually I haven't, there we go. I've said here, companies like Kodak, Blockbuster, these were some of the biggest companies in the world. But then if we look at the smaller end of town, how many people have gone broke over the past 2 years due to COVID? And it was completely unforeseeable. No one thought COVID would happen. I think a few people might have predicted it, but they didn't know it was going to happen. I certainly didn't. And to be honest, if you asked me in March 2020 what was going to happen with my business, I couldn't have told you. We'd just gone into lockdown. Is anyone going to buy a property during the lockdown period? Turns out they did, but I didn't know that. The property market was very, very resilient throughout COVID, and I think it's a good example of the old sort of cliche of people needing a roof over their heads. So good properties in good areas where there's strong reasons for people to want or need to live there. There's always going to be demand for that, regardless of the economic or political cycle. So that's one of the beauties of property. Some of the sort of returns that we aim for from property is generally a minimum net yield on funds applied of 5 to 10%. So using that same example of 50 grand into a 200 grand property, we should be able to achieve at least 5 to 10% net on that cash. That's after all expenses. So after your mortgage, your management, all the rest. So, if we're talking one property, that's £2,500 to £5,000 of net cash flow. Now, that's not significant when you've got one property, but when you've built that portfolio to 10, which is quite achievable over a 5 to 10 year period, that's 25 to 50 grand, which for most people, that's enough to live, or at least enough to supplement, income from elsewhere. But growth is really where you make your money. So 50 grand into a 200 grand property, the UK average for capital growth over the past 20 years per annum on average has been just over 5%. So that includes any downturns in the market. We look at things like the credit crunch in 08, 09, the dot-com bubble in 99, 2000, where there were some dips in property prices. Those dips generally only last 12 to 18 months, and then the market turns positive again. So that just over 5% includes those dips. And therefore, you can have a relative amount of confidence in achieving at least 20% returns on the cash you've invested from a growth perspective, because you've multiplied your cash 4 times. So it's 5% on the asset value, which gives you 20% on your cash. Now, if we add that together, we're at 25 to 30% per annum, and I'm yet in my 15 years in the industry to hear a logical argument that tells me that's a bad return. It's a really good return, but what makes it even better on a risk-return basis is that we can be quite confident in getting it every year, or at least on average every year. And you're not taking a lot of risk, because really, what is your risk when it comes to investing in leveraged property? The main risk is not being able to service your costs. But if we're investing in good properties in good areas with all the right fundamentals and all the right driving factors that attract a lot of people to want or need to live there, then you will have a tenant the vast majority of the time, and that tenant will pay you rent, and that rent will cover your costs. Therefore, that risk is mitigated. So that's what we really like about property, and especially so for business owners that are generally quite time poor. You know, you're running a business, or maybe multiple. I've got about 20 businesses, so I'm quite busy. I've got a family. You know, I don't really have that much spare time. I don't know how I manage to do developments as well, but that's generally because I get other people to manage them for me. But for business owners, you know, passive buy-to-let is great because it takes up very little amount of your time. If we look at what your investment options are, though, this is from a report. It's a little bit dated from 2013, but I think it's relevant because it's over an 18-year period leading up to that. And what it looks at is the different types of returns from the different asset classes over the 18-year period leading up to that time frame. So it's by a research house called Wigglesworth. It was commissioned by Paragon Mortgages. And it looks at the returns from leveraged buy-to-let versus cash-bought property, commercial property, shares, gilts, and cash. So as you can see, leveraged buy-to-let has substantially outperformed the market. So forget about the headlines that you've read that says buy-to-let's dead because of things like Section 24 and stamp duty premiums and mortgage serviceability changes. All of these returns are still very, very much achievable in the right circumstances with the right properties in the right locations. It's not a hobby anymore. You can't just buy the property next door and hope to make millions. Certain locations, certain properties work a lot better than others. And that's really where we come in, is helping you determine that and determine what's most suitable for you. So why buy-to-let for business owners? Well, first off, I mentioned before about having your main company being company A, and then you can set up company B being the property company. Now, company A can lend those retained profits over to company B, and then you can leverage that money to invest in property. So you're keeping the money in what is quite a tax-efficient vehicle, being a UK company. At the moment, the tax rate in UK company is 19%, which is one of the best in the world. I think Ireland's 13%, which isn't that much better. So rather than paying 40 or 45% personal tax rates on the money, you're paying 19%. You're keeping it within that structure by lending it across. You own both companies anyway, so you're pretty much just lending to yourself. You can then leverage that money by, say, turning 50 grand into 200 grand. And as you build the property portfolio, quite often the returns from that portfolio could end up being better than your main business. And I added in here some stats. The Office of National Statistics, or ONS, says that the average return on capital from UK non-financial companies over that same time frame was 13%. So by reinvesting the cash into your business and growing your business, on average, you can expect to achieve 13%, whereas in property, you can expect to achieve much more than that. Leverage property anyway. So as the portfolio grows, it may make sense to simply exit your main business and just live off your properties, which I think is the goal for a lot of people at the end of the day. You can also control the release of the funds and who those funds go to. So by having properties in your own name, that's more difficult. Whereas by having properties in a company, you can have your partner as a directing shareholder, you can add children as they become of age into the company, and you can disperse the funds in a more tax-efficient way. What a lot of people do when investing through a limited company, such as myself, I've never taken a penny from my buy-to-let properties. Anything that they make just goes straight back into them. I remortgage them, I reinvest, and the portfolio builds. At some point, I don't know when that will be. I'll probably die before I retire, but at some point maybe I'll decide to stop paying myself an income from my other businesses and maybe sell them and then pull an income from my property businesses. And that's generally the goal, is building the portfolio, and then at some point in the future you scale back your income from other places, and therefore it's more tax efficient to start taking the money out of the property business. You get the benefits of leverage. You get to hedge the risk of your main business. As I said, any business can go bust. Things can change literally overnight. A business that was great yesterday could be crap today, and you could be broke tomorrow. We all know that. That's the risk of us being business owners. So by having other businesses, unless you're an estate agent or a property developer right now, and that's all you do, then having a property business is probably a good idea because it's separate. It's a separate industry. It's different to what you're currently doing. So the whole goal here is to create passive income from proactively made profits. Now, most of you probably can't see these numbers, but what it looks at is that same example that I just gave. It's not very important to see all this, but it's a 200 grand property, 5% growth, and then remortgaging every time you have 25% usable equity in the property. So you start with one. This is what we refer to as the snowball effect. You start with one. By year 5, you have 2. By year 10, you have 4. Year 15, you have 8. Year 20, you've got 16. And year 25, you've got 32. And that's by investing one lot of 50 grand. If you're investing 50 grand each year, of course, that has a multiplying factor. But you can end up having 32 properties by investing one lot of 50 grand by very, very average driving factors in the UK property market. You can see how that tree there sort of builds out there. So most business owners we work with have more than 50 grand to invest, or have the ability to invest more than just one lot of 50 grand over a period of time. But obviously that can be quite beneficial. So what types of property? So I mentioned before that most business owners are quite time poor. Now, if you're time poor and you don't have any time, then it's exactly that. You don't have any time. You can't create more time. So therefore, you need to be passive. Unless you are a property developer or a builder, perhaps, and that is your business, and therefore you can shift into that business we just spoke about, maybe that can work for you. But if you're a doctor and you're working 100-hour weeks and you've got a family, then you cannot be a property developer. Unless you're just going to get someone else to do it for you, you need to be passive. And therefore, off-plan, new or near-new properties are the best types of properties to invest in because they are the most passive. Off-plan is quite a broad term. I certainly wouldn't say to invest in all types of off-plan properties, but some can be very good in the right circumstances where all the right boxes are ticked. And new properties come with all the right warranties. So, for example, usually you'll get a 2-year builder's defect period, which means that literally everything is under warranty for the first 2 years. There's no maintenance. You'll think things like your oven, your dishwasher, your fridge, they're all under manufacturer's warranty. So it results in a much more lower cost, lower maintenance type of property. I suppose like a box that generates you money, rather than thinking about it in an emotional way, which is, I think, the way a lot of people think about property. They live in a house, they think they know property because they live in a house, and therefore they try to buy properties that they like. Well, that's not really what property investment is about. It should be unemotional, commercially minded. It should be about what your target market wants and likes, and investing in locations that have really strong driving factors to improve, as opposed to being down the road from you. Another benefit of new properties, especially when working with a company like ours, is that you get to pick and choose between the better properties that are available within the development. So our clients invest in about 20 to 30 properties a month, and therefore we do get the pick of the bunch. We get to, for example, sometimes we find that the best properties in the development aren't necessarily more expensive than the worst properties in development. The developer just wants their price per square foot. They don't really care. So we get to pick the best there, and our clients get the best properties and that are actually worth more for the same price as the worst properties within the development. So that's something that we've got a lot of experience in doing. So what is your current situation, and therefore what's most important? So this is quite important because it depends on your stage of life. If you're just starting out, you've got 50 grand to invest, and you go and invest solely for income, and let's say you get a 10% net yield on that 50 grand, that's 5 grand, which is pretty good, but that $5,000 per annum, that doesn't grow. It stays the same. And the only way you can grow income through investing for income is by investing more cash. And for most people, that's difficult to generate significant amounts, unless you're a very high income earner or your business is very, very profitable. That's going to be a very slow way of building a portfolio. Whereas if you're investing for capital growth, as I mentioned before, 20% growth per annum plus a bit of income means that you should be able to remortgage your properties every 3 to 5 years or thereabouts. And therefore you're turning 1 into 2, 2 into 4, 4 into 8, and so on. So if you don't have a big enough asset base just yet, then growth should be the main focus. Or if you don't have enough sort of resources available to you on a yearly basis. Whereas if you do, then perhaps income should be the focus. Some people come to us having come into a windfall, whether that be selling a business or inheriting money or winning the lotto or whatever. And they've got a few £1 million to invest, they want to retire tomorrow. Well, in that case, it's more about securing that money and generating as much income from it as possible. So it really does depend on your stage of life. Working out your end goal, as I mentioned before, is very important. And I've given you an average there of 50 grand passive income per annum, because I'd say that's probably about the average that the UK average couple tells us they need to live as a sort of minimum to live comfortably. Now, that's very different depending on your lifestyle. Some people would spend that in a weekend and others wouldn't spend it in 3 years. So you can work that out for yourself. But if you need 50 grand passive income per annum, then and you're confident in generating a net yield of 5%, which I'd say is quite a good benchmark to use. You can get better than 5% in today's market, but things change, and we're talking, long term here. We're talking decades. So 5% is a good conservative benchmark. You'll need £1 million of investable assets. So that excludes your home, because your home doesn't generate you an income. It excludes any personal assets. This is investable assets. So that could be one property worth £1 million generating a 5% net yield, or it could be 10 properties worth 100 grand each, or of any different combination with debt and all the rest. But essentially, the net equity of £1 million should generate you 50 grand of passive income, relatively confidently. How to work that out? Take your passive income goal, divide it by your achievable net yield, which in this case is 0.05, and that will give you your investable asset base required. So that's one of the first things that we do with our clients when it comes to sort of working out where you are now, where you want to be, what's the gap, and how do we go about closing that gap. What number of properties do you need is a bit of a trick question, because it doesn't matter. It's a very common question I get asked, but believe it or not, investing in property isn't about bragging to your friends at dinner parties about how many you've got. It's about improving your financial position. So, that could be having 2 or 3 properties, or it could be having 20 or 30. It just depends on your situation, your goals, your preferences, how much of a headache you want to manage, all those sorts of things. So, some final notes. Please do fill in those feedback forms for me. If you haven't done that yet, please do it now. If the person next to you hasn't done it, tap them on the shoulder and tell them they're doing the wrong thing, because I've stood here and I've spoken to you, and hopefully you've taken something away from what I've said. So to pay me back, you need to fill that form in. And you go in the drawer to win the iPad as well. So it's not just me being selfish. The book, as I mentioned, if anything I've spoken about has been interesting, please do pick up a copy of the book. It's on the stand for £2. The reason we don't just give it away for free is we don't want it going in the bin or going under someone's bed. £2, which is less than what it costs to print. Or feel free to pick it up on Audible as well, which is the audio version of it. We have lots of free educational materials on our website, which you will also receive via email by filling in that feedback form. Over the next couple of days, we will email those out to you. Property Elevator. We're doing Property Elevator live at 1:30 in the main auditorium. I'd strongly recommend that you come along to that. It's a good bit of fun, but it's real money too. It's essentially, well, I hope no one sues me for this, but it's essentially the Dragon's Den of property development. It's a good bit of fun. The team, the angels, aside from myself, are the most experienced in the industry. Say aside from myself, they're all much older than me. And I like to remind them of that. But yeah, we're talking real deals, real money, and people are pitching for that money. So it's certainly worth watching. It's quite entertaining. Property Summits is another panel that we've put together. That actually most of the Property Elevator panel are on that panel as well. There's a couple of different people involved, but essentially Property Summits is all about education. So that's also on Sky. You can also look that up on YouTube or propertysummits.com if you're interested in digesting some more educational property materials. Obviously, ask any questions you might have on our stand downstairs, which, as I say, is right next to the main auditorium. And thank you very much for listening.